Think about this for a moment. You may have spent 30 or even 40 years paying off your home, month after month of payments, sacrifices, and hard work. Today, that house is likely your largest financial asset. But here's the real question. Will your home become a powerful retirement tool or a tax problem that slowly drains your wealth? Most seniors don't realize how serious this can be. One incorrect tax decision could cost tens of thousands, or even hundreds of thousands, of dollars. The good news is that you have far more control than you might think. In today's video, I'm going to explain 4 powerful tax pillars every senior homeowner needs to understand. Everything will be explained in simple English with no complicated legal jargon. Make sure you watch until the end, because the final point could potentially eliminate federal taxes on Social Security for many seniors. Let's begin. We'll start with what is easily one of the most powerful and generous tax benefits in the entire U.S. tax system. It's called Section 121, also known as the home sale exclusion. For senior homeowners, this rule can be a complete game changer. Here's how it works in simple terms. If you are single and sell your primary residence, you may exclude up to $250,000 of profit from federal taxes. This is not a deduction, it's an exclusion, which means the Internal Revenue Service treats that profit as if it never existed. If you are married and filing jointly, the benefit doubles. You can exclude up to $500,000 of profit completely tax-free. For seniors who purchased their homes decades ago and watched property values rise year after year, this one rule alone can unlock hundreds of thousands of dollars to support retirement, eliminate debt, or create long-term financial stability. Of course, there are a few requirements to qualify, but they are simpler than most people expect. Within the 5 years before selling the home, you must pass 2 tests. The first is the ownership test, meaning you must have owned the property for at least 2 years. The second is the use test, which means you must have lived in the home as your primary residence for at least 2 years. For married couples, one detail is especially important. Only one spouse needs to meet the ownership test, but both spouses must meet the use test to qualify for the full $500,000 exclusion. Here's where the tax code becomes especially friendly for seniors. A surviving spouse has up to 2 years after the passing of their partner to sell the home and still claim the full exclusion. If you need to move because of health-related circumstances, you may qualify for a partial exclusion. And if you relocate to a licensed nursing or care facility, the rules become even more flexible. In that case, you only need 1 year of use during the last 5 years. When applied correctly, this single rule can save a significant amount of money and create the foundation for smarter housing decisions in retirement. Now, selling the home isn't the right option for everyone. Many seniors say, "I've lived here my whole life. I want to stay right here." The good news is that the tax system actually supports that decision. If you choose to age in place, certain home modifications may qualify as medical expense deductions as long as you itemize your deductions. The key concept to understand is the 7.5% AGI threshold. Medical expenses become deductible only after they exceed 7.5% of your adjusted gross income. For example, if your AGI is $60,000, the first $4,500 of medical expenses does not count. However, any amount above that threshold may reduce your taxable income. So what types of home improvements qualify? The Internal Revenue Service focuses on purpose rather than appearance. If a modification is primarily for medical care, safety, or mobility, it is treated as a medical necessity instead of a luxury upgrade. Common examples include wheelchair ramps, bathroom grab bars, widened doorways for walkers or wheelchairs, stair lifts, and other safety-focused bathroom changes. Because these upgrades typically do not significantly increase the resale value of the home, the full cost may be deductible once you pass the AGI threshold. For seniors dealing with mobility limitations, these deductions can meaningfully reduce the cost of staying independent at home. But what happens when a home improvement does increase your home's value? For larger projects, such as installing an elevator or building a therapy pool, the Internal Revenue Service applies a straightforward formula. You take the total cost of the improvement and subtract the increase in your home's market value caused by that upgrade. The remaining amount becomes your deductible medical expense. For instance, if you spend $20,000 on a therapy pool and the project increases your home's value by $12,000, then $8,000 would count as the deductible medical portion. When used strategically, these rules allow seniors to improve safety, comfort, and quality of life while still receiving meaningful tax relief, without needing to sell the home they worked so hard to build. After discussing the option of staying in your home, the next major question many seniors ask is, what if I need cash, but I don't want to sell? This is where reverse mortgages enter the conversation. And, unfortunately, this is also where confusion and misinformation are very common. A reverse mortgage allows homeowners age 62 or older to convert part of their home equity into cash. This can come as a lump sum, monthly payments, or a line of credit. The first question most people ask is whether that money is taxable. The answer is simple and reassuring. No, it is not. The Internal Revenue Service does not treat reverse mortgage payments as income because the funds are classified as a loan advance rather than earnings. This means the payments generally do not increase your taxable income, do not push you into a higher tax bracket, and typically do not affect your Social Security Administration benefits or Medicare eligibility. However, things become slightly more complex when discussing interest deductions. With a traditional mortgage, interest is paid monthly and may be deductible each year. A reverse mortgage works differently. Instead of being paid monthly, the interest is added to the loan balance over time and usually is not paid until the loan ends, most commonly when the home is sold, or when the borrower permanently leaves the property. Because of this structure, reverse mortgage interest cannot be deducted year by year as it accumulates. Instead, it can only be deducted after the interest is actually paid. Typically in one large amount at the end of the loan. There is one more important rule that many seniors overlook, and it can make a significant difference. Even when the interest is eventually paid, it is deductible only if the reverse mortgage funds were used to buy, build, or substantially improve the home. If the money was used for daily living expenses, travel, or even medical costs, the Internal Revenue Service does not allow the interest deduction. Understanding this distinction is critical. While reverse mortgages can be a powerful cash flow tool during retirement, the tax benefits depend heavily on how the funds are used. When structured properly, they can provide flexibility without creating unexpected tax problems, which leads perfectly into our final pillar. Now let's talk about something that truly has the potential to reshape the financial outlook for millions of seniors. Tax laws are always evolving, and whenever new benefits are introduced, they can create powerful planning opportunities. Imagine a new tax rule that provides an additional deduction specifically for Americans age 65 and older, designed to deliver direct financial relief during retirement. This type of deduction wouldn't replace any existing benefits. Instead, it would stack on top of the current senior standard deduction, creating an even stronger shield against federal income taxes. In this example, assume the new deduction is $6,000 per person. That immediately increases how much income seniors can earn before taxes ever apply. When you look at the numbers, the impact becomes clear. A single senior standard deduction could rise from roughly $17,750 to about $23,650. Meanwhile, a married couple where both spouses are age 65 or older could see their deduction increase from around $35,500 to approximately $47,500. An increase of that size would make the standard deduction the obvious choice for millions of retirees. More importantly, it would significantly reduce taxable income for seniors who depend on Social Security, pensions, or moderate retirement withdrawals, exactly where tax relief matters most. This is where the real opportunity appears, especially when it comes to Social Security benefits. Many seniors are surprised to learn that a portion of their Social Security income can be taxed at the federal level. However, with a deduction this large, many retirees could see their taxable income drop low enough that their Social Security benefits are no longer taxed at all. No longer taxed at all. Yes, for a large number of seniors, this could mean zero federal tax on Social Security income. That directly improves monthly cash flow and strengthens long-term financial stability. without requiring any change in lifestyle or spending. So let's bring everything together. Your home is not just a place to live. It is a strategic financial asset when you understand how the home sale exclusion works, how medical deductions can support aging in place, why reverse mortgage income is not taxable, and how senior-focused deductions can reduce, or even eliminate, taxes on Social Security. Once you understand these rules, you stop reacting to the tax system and start planning around it. The real question now is what your next move will be. Will you sell, stay where you are, or tap into your home's equity? Whatever path you choose, one thing is certain: knowledge puts you in control. If this video helps simplify these complex rules, make sure to subscribe to Money Truths, where we break down complicated policies into clear and practical insights for seniors and their families. See you in the next video.